Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about Netflix. So, Netflix just reported their Q4 results. Gonna go through that. Gonna talk about why this is a new changes of a new leaf for the company. I'm gonna talk about how to think about its valuation. Then I'm gonna talk about some of the key metrics that you need to think about. Okay. So, Netflix is a stock that I've been quite bullish about in the past year, and this set of results really took me by surprise because I was really bullish this company. And you can see here, so in the past year, I've been kind of an unwavering bull, but right now, what I see, I mean, really dramatically changes the overall thesis here. Now, this is quite interesting, right? So, in the past year, small and mid cap stocks have been selling off. It's been quite consistent since about February. Then, large cap stocks have been really immune to that. So you've seen large caps kind of staying around and really the S&P, everyone reporting all-time highs, all-time highs. And the large caps have been really everyone that had any spare capital has been moving to large caps. They've been perceived as a safe haven. But starting really the last several weeks, there's been a change, and you can see here with Netflix, it started to sell off in the last several weeks, and then after hours, it's down a further 20%. So what's really happening here is that the guidance is pointing to just about 10% year-over-year growth rates. Now I know that they're lowballing that, but even looking beyond that, if they're guiding for approximately 10%, this implies that the company is starting to mature. If the company starts to mature, this has a dramatic implication on the multiple that investors will be willing to pay for the stock. Not only is 10% growth rate the slowest Netflix has guided for in many quarters, but it's also dramatically lower than what analysts expect. Analysts were expecting approximately 13%. And analysts, they're quite favorable towards Netflix, so they would have been lowballing that as well to kind of allow the company to put out a beautiful beat. But as it transpires, expectations were kind of lowish, and as it turns out, it's even should have been even lower. So everyone is kind of focusing on Netflix subscriber number. The subscriber number has been something that Netflix has been indoctrinating investors to focus on. Kind of, focus on our subscriber numbers. Paying subscribers is what really investors should be focusing on. And don't worry too much if the business doesn't make any free cash flow, which is that's fine. Just ignore that. And for a long time, investors have been quite happy with that. Subscriber numbers have been compelling, and it makes sense, right? Because subscriber numbers ultimately drive revenue. So if as long as subscriber numbers are going up, you've got some price increases along the way. All is good. Now, just as a reminder, so the subscriber number that they were kind of expecting was 8.5 million additions, and they came in at 8.28. So it's not a huge miss. That's not the reason why the stock is down 20% after hours. It's more to do the expectation looking ahead. They're pointing to a meaningfully lower subscriber number. That's translating into a meaningfully lower revenue growth rate than everyone was expecting, just 10%. Netflix growing 10% is really the profile of a mature company. Now, last year, for the first time, Netflix put out its stock performance on its shareholder letter. They said, going forward, every January, we're going to do this. And what you see here is that anyone that came into the stock in the past 3 years, 5 years, or 10 years has been really rewarded. Right now, they're not being so rewarded in the past year. Particularly compared to the S&P, you can see 11% compared to 29%. What's more, if you think about it, right? So what they're saying is really it pays to be patient. And as an investor myself, I'm fully aware that it pays to be patient. But I also know, as you do, that Netflix's strongest revenue growth rates are now in the rearview mirror. And this boils down to the valuation. So it becomes quite difficult to value this business, right? So if you know that your strongest growth days are now in the rearview mirror, that implies the multiple that the investor is going to be paying for something. And let me tell you, multiple compression is probably the worst thing for you as an investor to have to embrace. No matter how cheap something is, the stock can continue to become even cheaper. You think that it's irrationally cheap now, it can become irrationally cheaper later. Now, here's an example, right? So, in the case of Zoom in the past year, you see the multiple compression. So, the stock was being priced at approximately 60 times forward sales, and just like, and now it's at approximately 11 times forward sales. So, that even if the company grows into that valuation, the multiple compression drives the share price lower over the course of a year. Even though Zoom is growing really, really fast, you see how that changes, just the change of people's perception of where the growth profile is going to be. So the same here with Netflix, you can see that as the perception of the business starting to slow down, that's going to cause a very rapid sell-off, and it's going to cause the multiple to compress further. Now, buying fallen angels is bad for your wallet, but it's also bad for your health. And when you're kind of thinking about, oh, should I really buy the dip here? So Netflix, historically hasn't really been a very strong free cash flow generating business. It has barely about break even for 2021 as a whole, the free cash flow number. And the investors have been quite happy for the business to be free cash flow negative, provided that the revenue growth rate was rapidly growing. If the revenue growth rate is not rapidly growing, and if people can start to see that it's slowing down, it makes you think, is the amount of capital that Netflix is spending to acquire new content like the Roald Dahl series and just new content overall and building out their library, I invest in seeing a very strong return on investment, and it doesn't seem to be so. Uh, I know that investors will say, oh, but look, if you look at the amortization of intangibles, it shows they have a very strong return on invested capital. That is one side of the equation that everyone says, oh, the GAAP numbers are strong. And that's a topic for another time, but the free cash flow isn't strong. So it's kind of like, are you getting paid in free cash flow? Or are you getting paid on the earnings number? So it's kind of like that. So I believe that, ultimately you as a shareholder, the owner's earnings translate into strong free cash flow. And that's why companies, let's say like Amazon, just investors are quite willing for them to be investing for growth because you can see a very consistent, predictable revenue growth rate, and there's not a lot of surprises along the way. Okay, so the more certain the growth rate, the higher the multiple investors are willing to pay. And if it slows down, as it appears to be slowing down, investors will not pay a very large multiple. So just for context, investors are now asked to pay 5 times this year's revenues for Netflix for a business that is expected to grow in the mid-teens compounded annual growth rate. Isn't that attractive? Because there are so many tech names right now that are growing so much faster than this and being priced significantly cheaper than this. It's difficult to see a reason to buy this dip. Now, over the very long term, the share price aligns with intrinsic value. But over the shorter term, sentiment plays the two sides of the equation. So for growth investors, they're not really going to be wanted to get involved here because for growth investors, this is not a high rapidly growth company. For bargain hunters like value investors, they're not really wanted to get involved here because they don't want to pay a premium for something that is, not generating any free cash flow. So over the next several weeks and months, you're going to see the shareholder base change quite significantly, and it's going to be quite difficult for new investors coming in to find a compelling opportunity here. So